Oh,
Recording.
I didn't know. I couldn't see it. I'm watching it. But hello. Is it working?
Hi, yeah, it's recording, it's
Yes.
streaming.
Cool. Hello and welcome to PSBS, where Paul, him, and Sydney, me, BS about money. Today's topic is financial accounts. Oh wait, no, crap. I need to press the button. I'm going to do that again. I just didn't press the button that'll make it listen to me. So, hello and welcome to PSBS, where Paul, him, and Sydney, me, BS about money. Today's topic is financial accounts. And we're going to talk about accounts, and it's going to be fun.
Yay. I hope you watch the YouTube video after this because I was just face palming the whole time, whatever just transpired.
Well, I'm always put together, obviously.
Yeah. Um, okay, so we're going to talk about financial accounts. We thought this would be a good episode one because episode zero, if you haven't watched it already, you should. We had 7 views on
It
YouTube.
was so much fun.
Uh, and I don't know, did you try uploading to anything else?
No, I have a cache, and I'm keeping a cache of our stuff yet. And it's a little more involved to make a podcast.
Gotcha. Okay. But we are up and running on YouTube and Twitch, as you know, if you're watching this live. And I keep looking to my left because my second monitor is over here, so just ignore that. But we thought financial accounts would be good because we introduced ourselves on episode zero, and financial accounts are pretty much critical because it's the account that holds your money, and there's
Or it
stuff.
does stuff with your money,
Yeah, it does
or you
stuff.
tell it what to do with your money. It makes your money happy.
Yeah, and it depends on your goals and strategies, and it's kind of the starting point of everything. So, at a high level, we are going to talk about not really definitions, but more just discuss each account. Uh, Not like a lecture, but more just like kind of what we do and what other people do. And
And
again,
hopefully introduce you to accounts that you've never even heard of and might benefit from.
maybe because Sydney probably has researched this all day because she's so excited.
A little bit.
So it'll be good. And yeah, do you want to start with
Okay.
something?
So I've also broken these down into categories. So I think if we start a little bit simpler, it might be easier to get into the harder stuff. So my first category is like day-to-day stuff. So you might think about having a checking or a savings account. And so a checking account can hold your money, and then a checking account, a bank might offer you, or there are what are they called? Unions or something that might offer them as well. And then you can have them either just yourself or a joint account because you and a spouse or you and a parent might get on it together so that you can both like put money in, take money out. And banks may charge fees on checking accounts, but if you have certain balances in there, you'll be fine. Or if you have a certain amount of activity, if you have direct deposit from a job, then that's a great way to get one for free. And then the third type of a checking account is a business one, but unless you're an awesome entrepreneur, you might be, I don't know, then you don't have to worry about a business checking account.
So wait, your first one was a day-to-day checking. What was your second one?
Oh, this is my day-to-day category of accounts. And so checking account and savings accounts. Savings accounts
Gotcha.
are actually a little more restrictive because a lot of places you need minimum balances, but they give you a higher interest rate. So a
Yeah.
checking
Well,
account,
yeah.
go ahead.
I hear what you're saying. Savings accounts right now for banks are terrible because they can be good for like just putting money aside, but the interest rates on them are so minuscule. It's
But they're
almost.
actually going up. They're going up right now
Yeah,
because
slowly.
lots
I
of
think it went
reasons.
up like a quarter of a percent because the Fed raised interest rates. Like that's it.
Yeah, but
You
if
want
you
to know
if
how
you
much
look for
money I made on my savings account last year? I made 41 cents. 41
well,
cents. What am I gonna do with 41 cents? I don't even keep change in my wallet.
if you have your money in a savings account over having it in like any other account, it's at least accessible. That's the point of like having it like closer to home because if you put it in something where you can't access it, it might give you a huge return, but then you're not going to get it for 3 to 5 years.
Well, that kind of goes into like what we talked about a bit. I think on episode zero about we were talking about risk and accessibility, and I'm
Absolutely.
blanking on another word, but like it's risk reward type of thing. So you can have immediate
Definitely.
access to like an account of any type, but
Mhm.
usually the returns are going to be great. So
Right. And like a kind of little bit of a middle version of that would be a certificate of deposit. And so that is a bank offers you to put your money with them like a savings account, but it's locked up in there for a higher interest rate for a longer period of time. Like if you know you're not going to need to spend this money, if you're saving it for a certain reason or you want to go do something awesome like travel or even something that you maybe mid to longer term money that you might know you need to spend later, having a certificate of deposit is a great way to keep it with the bank that you might already have a checking account with, so it's easy to move it back once you're done. So certificate of deposit is kind of like a step up from a savings account.
And as of right now, it's not even that better. This is because
Yeah.
interest rates are pathetic right now. They're so low that you don't really get that much better return than a savings account, and a savings account is nothing. So,
So it's better than it's worse than inflation, but it's better than having it do nothing. If you're gonna have it, stick it under your mattress at home, that's probably maybe a little safer. Probably not though, because banks have a lot of ways to give you back your money if it gets stolen.
well, yeah, they're FDIC insured up to $250,000. For those of you who don't know what that
Uh,
means, your government uh, insures your money when you save at a bank up to $250,000. It's just so that way there's not like a panic if anything starts to go wrong with a particular bank and consumers don't take all their money out of the bank and put money out of business and start this huge panic. I'm sure you could Google it or we could talk about it later on different podcasts, but that's
so
pretty much
like
the gist of it.
you and me who don't have $250,000, all of our money would be safe in a bank.
Correct. So, um, but what I wanted to circle back to is certificate of deposit is good because it's got a little bit better, savings rate and returns than a savings account and a checking account, obviously, because most checking
Hmm.
accounts give you zero, and just some of them have fees if you don't even have high enough balances or
Yep.
transactions that you're processing. But um, your money is inaccessible after you
Right.
kind of commit. So, and they can do, I don't know if they do 3 months, but I know they do 6 months certificate of deposits. And
Hmm.
my dad at one point did one that was 5 years long, but that's when
Nice.
interest rates were, I think, like 5 or 6% for them. So he
Oh,
just like
nice.
had some money, put it in there, and it saved up. I think it was for like my college or something.
Cool. Lucky
But
you.
yeah, no, it was smart. But I'm not a huge fan of them because it restricts your money, and I feel like back in the day, certificate of deposits were good because that was just a more advantageous way to save.
Sure.
And it's like
There
I don't need this money right now.
there is one bank that I did a certificate of deposit once with Ally Bank. It's a bank I currently have my savings with because their interest rates are crazy high right now.
Yeah,
Well, for a savings account.
yeah,
But what they do is they have a type of CD. It's 11 months long, and I forget what they call it, but it's so that you can take your money out at any time. But the reason that it's beneficial to them is that your money is technically locked in. It's not going to come in and out. You will
yeah.
just give up having that return on your CD for the rest of the time period if you take it out at any point. So it's beneficial to you because you can take your money out if you need it, but then it's also in there at the interest rate that's higher than a normal savings account. I actually have two checking accounts, two savings accounts, and a couple other ways for the money to get in between. But one of my savings accounts is my rainy day fund, so I'm not touching that one for a while.
Yeah, and I mean it. The checking and savings accounts are very general accounts too. So like you can
Hmm.
have a checking, you can have 100 checking accounts if you want to. You don't really need it, but like I think it's more advantageous to do that if you can set up accounts to pay certain bills, or
Absolutely.
you can set up a checking account literally just to have money go in and money go out into all your utilities or rent or whatever, and have your other checking account to pay like any other miscellaneous stuff. But
Sure.
um, I think it's more advantageous to have multiple savings accounts if you know what you're doing. So I have two savings accounts right now in my bank, and one of them is just like a general savings account that I automatically have stuff just like go to every month because I
Nice.
know I'll need that liquidity eventually. Like for example, even today I took like $1,000 out of my savings account just to help pay off some massive credit card bills because we had some wedding expenses and vacation expenses. And so
That's
even though
okay.
it's not really getting me a good return, like I was telling you, it made me 41 cents last year. It still was good to have a little bit of extra money that I can transfer immediately in one day. Um, which is, I hate using that account because it doesn't give me anything back. It's just sitting there. But at the same time,
Hmm.
I transferred it immediately because my credit card was due. And some of my other investment accounts that I can still get money out from take like a week to process. So
Oy.
it was good to have that there. And then my other
Well,
savings account is just for like I save for like miscellaneous stuff. Like I haven't really used it since college because it was like I was saving money for like tuition. I just wanted to keep it separate because I was using it for a very specific purpose. So
totally. Well, I think that's actually a great transition if you want to go kind of on like the debt side of accounts, because there's a lot of different accounts that you might hold that where someone has loaned you money in some way. Like a credit card is a great one. I have multiple credit cards. I think I have a total of three of them, and I have them for different reasons. I got them for different reasons at different times, but I actually have to manage them. Their information shows up on the same page as my bank because two of them are actually through my bank. So I'm able to see the account activity and what I've spent and when they close, how much is due. And that's kind of like the base level of a debt account.
yeah, and the credit card accounts again, the most basic form of debt, pretty much. But I would say it's probably the one you need to look at and manage the most,
For sure.
because something like a mortgage, something a loan that you take out for when you're getting a house, for example, is pretty much structured that it's like here's what you need to do every month, like just pay this amount and more if you want to. That's it. A credit card varies. It tracks all your daily expenses if you're using a credit card.
Hmm.
You should be using a debit or credit card instead of a debit card. If you don't know what the difference of
Absolutely.
those is, like you need to get a credit card. Because it's much safer to have a credit card. You're only liable for a minimal amount of money if there's fraud. If there's fraud on your debit card, you're kind of screwed because
Pretty much out of luck.
the bank will still help you, but there's not as much protection for it because it's directly linked to your account.
And if you're worried about having a credit card and going over your limit, or you don't think you can hold yourself to not spending too much, there's actually a lot of credit cards out there that will give you certain limits and let you set limits on it yourself or boundaries to what you can and can't spend. Like there are actually some credit cards you could get for your kids if you have them and they're of credit card spending age, just to teach them the ways to use the credit card and not overspend, but that way they can manage how much money they have, as well as yourself if you're interested in doing something like that. Credit cards are a great way to get into the debt side of things. But as for the mortgage, it took a ton of paperwork to get into one. But now that we're done, it's easy going from here for the next I think literally 30 years. We're paying the same amount every month on our mortgage, and not looking forward to that for the next 30 years. But at least it's no hassle from this point forward.
Yeah. And I would say credit card and your checking account are the two accounts that you should be looking at on a very almost daily basis. You don't want to start obsessing over it, but at a minimum, you should be looking at it like once a week. Um,
Well, I'll say if that scares you, you don't necessarily have to if you have a plan in mind. Let's say, you know how much you're going to spend, or you have an idea of when to look at it so that you know at what point you need to stop spending, or even when the date that your credit card closes every month is, to look at it before or after then to know how much you have to pay down the last statement. But I mean, if it doesn't scare you, then it's really cool the kind of information you can get from looking at your credit card statement, because a lot of credit cards do statistics and categories that you spent your money in. And if you get a credit card with rewards of different kinds, then you can actually benefit from knowing what categories you spend your money in. Because right now, I think my Chase benefits from getting grocery stores, but my Amex, my American Express card, benefits from gas stations. So I use them correctly to get more rewards for each instead of just putting everything onto one credit card.
yeah, and that's an important note on credit cards is like the rewards that you can get may not
For
seem
sure.
very much, but they add up over time
Totally.
significantly. Um,
Hmm.
and that's not something you really need to actively manage either. Like I have a credit card, I think it's Chase Sapphire, gets me like points that I can apply towards rewards or Amazon or whatever. And then when I was running my sports supplement company, De Novo, we had a cashback credit card that was like 2% of all purchases. Well, 2% may not seem like a lot because like someone like me, my average credit card bill is like less than 2 grand. But, that's like 20, $40 a month. But,
Hmm.
I was buying like $10,000 purchases like every other month or something like that. And then if you get more debt, I think like our debt limits got over 50,000 or something like that. And you're buying more and more stuff all the time. It really adds up into a lot of money. And then depending on your bank, like I was at Bank of America when I was a part of that, and I just had it auto cash out because there was no like,
Nice.
it didn't matter, and it went right into the savings account. I never had to touch it, and it was a way to easily automatically build my savings account for the business month
Totally.
over month. But the one that I have for my credit card right now, my personal one, I just cash out the points every once in a while, or like if we're going on a trip, I'll like book a rental car or a plane or something like that. And it's kind of unique because even though it's like you're utilizing debt, it's a little scary, especially if you start spending too much. You can still get stuff. I don't know. It's kind of cool. Like I know I'm kind of rambling here, but like 500. I had took out like I cashed in like $500 worth of points on a credit card statement because I just forgot about my points after like a year or something. And it was just like, oh, cool. It's just another $500 in my wallet because I just accumulated points. So it can be good, but I try to look at my credit card like probably at least once a week, if not more frequently, because I have apps on my
Hmm.
phone that can help me manage that. Just to check for like fraud purchases and just understand what
Sure.
I'm spending money on. Because, if you go out to eat 3 times a day for a week, like that adds up really
It's a
fast.
lot of money. Yeah, I'm not saying I don't check it on a daily basis. I actually really kind of think it's fun to see. I have all of these different, I've managed my statement ending dates so that my paychecks kind of coincide with one and then the other. And so I kind of
Awesome.
check on a regular basis because I have all of my financial accounts and all of the financial activity end and do things on certain dates. So I'm kind of in my money on a regular basis, and that includes being in the credit cards. But I also think that if you're going to make a huge purchase in the near future, whether that be like a big piece of furniture or possibly like an expensive something like a piece of artwork or I don't know, it's a great idea to manage your spending ability at that time. And so getting a new credit card might be a good idea because there are a lot of bonuses to opening up a credit card if you spend a certain amount in a short period of time. So like when I had my wedding and we needed to put down the deposit on the well actually I opened a credit card because I was both starting to study for the CPA, so I needed to pay for those classes and getting wedding stuff deposits set. So I had so much money preparing to go out in the near future. Not only did I actually need more of a credit limit to begin with, so I needed to open a card, but I would meet the requirements to get all the bonuses for opening those cards. And I only opened one, but I would get all the benefits for opening them. And also, on top of that, the cherry on top was the 0% interest rate that I got for, I think it was 18 months for opening the card when I did. So I immediately spent thousands of dollars within like a 3 month period. And I was able to pay it off basically like a normal loan. And I paid it down to zero by the end of the 18 months because if you don't, then they end up charging you for the amount of money that you had in there and the period of time it was in there for at the interest rate they would normally charge you. So you kind of want to manage that and make sure that you can get it down to zero by the end of the zero. They call it APR. I think that's annual percentage rate. And so you want to get it down to zero at the end of you want to get your balance down to zero at the end of the 0% APR time period. But it can give you a lease on life that you didn't know you otherwise had. I don't actually know how I would have otherwise. I would have managed it, but I don't know how I would have managed the couple thousands of dollars I needed to like get out in 3 month period.
And I think that's a good strategy. Once you like understand like what you're doing with credit cards, like I would not
Sure.
recommend like, oh yeah, let me just go get 4 credit cards and just max them out
Well,
because
they
it's
might
zero interest.
reject you. Your credit score actually matters. After you open a card, your credit score goes down a little bit. And so they needed to make checks on your score to open your card. And then if you get rejected by a card, that also makes your credit score go down. And credit score is a whole nother thing we'll probably talk about someday.
Yeah, and credit cards, you should always try to pay off your credit card balance every month for them, because like I
Mm-hmm.
mean there are some rare occasions where like it happens, like I've been there, especially in like the business world, like sometimes stuff sits on there you don't want it to,
For
but
sure.
kind of the interest rate, the APR that Sydney was talking about, is annualized, and a lot of credit cards are very high interest rate, unlike
Mm-hmm.
your savings account where instead of it being for savings, it's how much the interest rate is how much the bank or the credit card company is going to charge you
Right.
for utilizing their debt. Because basically, what you're doing is you're using their money and not your own
Mm-hmm.
on the credit card. And so you have to pay it down because that debt is very expensive, especially on a credit card. And I think when I was applying last time, like on one of my credit cards, my interest rate right now is like 18%. So
That's actually good.
if I have
For a
like
credit.
$1,000 on my card and I don't touch it for a full year, they're gonna charge me $180 over the course of that year. So if you divide that by 12, that's actually what I'm being charged on a monthly
Each
basis,
month. Yeah.
and that actually compounds too. So I don't know what 180 divided by 12 is off the top of my head, but let's
You
just
mean you're
say,
not a calculator?
yeah, right. I mean, I think it's like $9 or something. Is that right?
Mm-hmm. Yeah.
No, that's not right. That's if you divide by 20. Anyways, it's like $15 or so. Let's just say it's $15 a month. Then it's like I have $1,015 of debt on my credit card, and then that compounds again, and then it's like it screws up a lot if you don't pay it off every month. And then
Mm-hmm.
basically what ends up happening to people and why they go bankrupt on credit cards is because they accumulate too much debt that they have a very hard time catching up because of the interest rates so high. And so if
Mm-hmm.
you let it sit on there for so many months and you don't have one of the zero interest rate credit cards like Sydney does, which we will let you know is a promotion. Like that is not an
Right.
actual thing, a zero interest credit card. And I think unless like you're a billionaire or something, like besides that, you really need to pay it off because it can compound into
Mm-hmm.
a major problem for you.
And if you found yourself in a situation where you're already there, where you're swimming in credit card debt, there are ways out of that. There are multiple ways out of that. Something that we ended up doing actually when we took on when we bought a car, we actually took on quite a bit of debt. That was separately a car loan, but we took on a lot of debt in a short period of time, and so there are balance transfers you can do. Usually, if you have a credit card with a bank, they will charge you a flat percent, which is much lower. Our offer was 3%. And then if once we paid 3% on the balance instead of the 24 or whatever it was you mentioned, my credit card's at 24%. Instead of the 24% annually, we paid the 3%, moved it off of the credit card, and then we basically had a year to pay it down. So it
Sorry,
was
what was
the
your fixed rate? Sorry.
it wasn't there was no fixed rate. The
Oh,
balance transfer was we paid 3%, so 3% of the balance was
yeah.
added to the balance, and then it was a 0% APR then for that point for a year. But again, if we didn't pay it down within that year, we would go back up to owing the APR from the credit card, the 24%, over the course of that time.
And did you call the
So
bank or what'd you do?
actually, Chris, my husband, he gets advertised these in the mail. So if you actually read those
Oh,
advertised mailings from banks, usually ones that already have your business will send you things that they think might benefit you. And in this case, we were roped into one, but it worked out. So I don't actually feel as guilty for
you mean
incentivizing
like
them to
junk
send me
mail
more
I just
mail.
throw away every time?
Yep.
And you don't read that? There's no way.
But I'm actually going to sneak into one other thing that I mentioned earlier for a car loan, and credit cards actually work into this really well. When we bought our car, we weren't allowed to put more than $2,000 down on our credit card. For some reason, different car companies have different policies about that. They want to basically get your business. They want your loan. So they
Well,
only
that's
let
how
you
they
put a
make
certain
money.
Exactly. And so our current car loan is something like 5%. It's a much better rate than a credit card, so it's worth doing. But if you can pay down, the more you can pay down initially with the car, then the less you pay over time because the less the interest has to build on.
Correct.
So it worked out well for us, but we got our car loan for another, I think, 5 years as well, four-ish at this point. But car loans are another way to have debt.
Yeah, and I mean, what I meant by crap, now I can't remember what I said. Um, but oh, the
I,
reason I said that it makes them money is because of the interest rate, just like we were talking
right.
about with the credit card. Well, the last thing I'll say about the credit card, probably before we move on, since we've been going off about this, is you can talk to the bank about your interest rate and
Yes.
your credit limit, which is very important because how much your credit limit is. I'm not sure about interest rate, but I know your credit limit. If you have more capacity of credit, you can then utilize it if needed, but you probably don't need to because they give you way too much credit as is. And but it will look better on your credit score and help you
Absolutely.
in the future. So even though if you're
Totally.
like, I can't remember what exactly my credit limit is, but I want to say it's like 30 grand or something on one of my cards. And you can, I use a fraction of it. I think the most I've ever put on is like 4 or 5 grand. And
Nice.
that, yeah, but I'm not going to use the full 30 grand. So just be careful when you do get a credit card. Just because you can spend $30,000 doesn't mean you should.
That's why they give it to you.
Yeah, and I mean for them it's great because they can make them money for all this time and it's fabulous. But you got to be very careful because it does get a little mind-boggling, especially when numbers get bigger and bigger. So
Definitely.
it's good to call though and check. I think I was reading a rule of thumb is you should have the most you should ever have your credit limit on a credit card is 12 times what you're going to spend on it.
Huh.
I think it was just like a rule of thumb based on like how it affects your credit score and your spending habits and stuff like that. So
I definitely need to get my credit limit up.
yeah, go for it. It's your average, not like your maximum
Sure,
though.
sure. Yeah.
So I mean, my average is probably like a little bit less than 2,000 a month, and
Mm.
if not sometimes a little bit over 1,000. And so like I'm kind of in that sweet spot for where I want my max to be. So
Actually, I'm in a very similar spot. I usually go between the two credit cards, 1,000 and 2,000, unless it's convention season and I'm getting hotels. If I'm booking hotels, that a little bit of a splurge,
for
but I
those of you
save
who
for it.
don't know, Sydney's a huge board game nerd, and her and her husband
Totally.
go on these fabulous like mini vacations all the time to gaming conventions.
It's so much fun.
Yeah, that's her guilty. Is it a guilty pleasure? I don't.
Oh, it is a totally like shameless pleasure. I love it
Okay,
so much.
I gotcha. So yeah.
But back to there's actually I'm gonna make this transition.
Oh
There's a game
god.
called Cash Flow, and it's super nerdy and super awesome, and it actually teaches you how to manage an investment. So if you play the game, you pick your investment and you end up like the game itself will randomize the result of the investment, and then you have to make decisions on what to do based on what happened to your investment. And there's lots of different ways you can do this. They range from like really short games because you're investing short term to long games because you want to see how many years your investment lasts. And so there's a great game out there to like mock this. And I haven't actually played it yet, but I've seen people play it and it looks so much fun to me at least. And investments. That's another type. There's millions of different types of investments, and we can shoot in the dark and get some of the more common ones here, like a retirement account.
Yes. If you're not utilizing your retirement, I don't know if every job has one, a retirement account. I think most of them
Mine
do.
doesn't.
Yours doesn't? I didn't know that.
No, I have to have it myself. I set it up myself once I decided that I should probably start saving again because I was so used to it being taken out of my paycheck
Yeah.
that I didn't realize that I wasn't actually putting money away. So I'm putting in more than I actually should for the rest of the year so that I max it out.
Right. And it is so what is a retirement account? Well, a retirement account is literally you trying to save so that at one point in your life you can stop working. Because we all
Hmm.
love working. Knowing me, I'll probably work to the day I die just because
Right?
I'll probably get bored. Um, but there are several different types of accounts, and when
Hmm.
they always have those benefit enrollments like every
At
year
work.
for at like work. You got to pay attention to that stuff, because if you don't start saving now, like, even if it doesn't matter what age, if you're not saving for retirement now, you need to start, because it is
Hmm.
many tax advantages on several accounts, and it is so freaking easy to do it.
Oh yeah.
Um,
So I'm going to
go
go
for it.
into like the types of accounts, and I will start this off with we are not financial advisors. The advice that we're giving is from our own opinions, not actually to advise you in what you do, because I have strong opinions about these different types of accounts. So my bias might come through in my explanations. But there is a 401k, which just is a fancy name for a retirement account that your company sets up for you. And that way you can elect to have money taken out of your paycheck before you get taxed. And then that money goes into a savings account. And so then once you retire, that money has grown and grown because it's invested. And then once you retire, you can take that money out, and you are only charged that's when you are charged taxes. When you take the money out when you've retired. But because you are no longer working at a company, the theory is you will be in a lower tax bracket. So that way you are taxed less on this money that you've put aside. And whether you're taxed less or not, you should put the money aside so you have the money when you retire. But the other two accounts that are available are outside of working for a company. So an IRA, again, I don't even know what it stands for. It doesn't really matter. An IRA is, do
We
you
can
know what it
find
stands for?
out though.
Yeah, I know, right? We have like millions of screens between us. Um, an IRA is basically a 401k that you set
Individual
up yourself.
retirement account.
Oh, that was too easy.
Come on, Sydney.
So an IRA is one that you set up yourself, and that you take money you already have and you put it into a retirement account. Now, how that works, because taxes are still a thing, you end up getting a piece of paper from the bank at the end of the year that tells you you put this much money in your IRA this year, and then you take that, you put it into your taxes at April 15th. So wherever, like if you do TurboTax or H&R Block, they will ask you if you've received this piece of paper by its official name, the form name, and then you'll say, yes, this is what this piece of paper told me. And then the taxes will be your tax obligation will be reduced because you've already paid taxes on the money you're putting away when it's outside of a company, because you're getting it in your paycheck and your company takes the money out of your paycheck before they give you the money. And the third option is a Roth IRA. And this one's a teeny tad bit more complicated, but in my opinion, actually better if you're on your own and you don't have the option of a 401k. I have a Roth IRA, is better than a regular IRA, because what happens here is the money you get from your company is already taxed. You take that money and you put it into a Roth. This time, though, the bank doesn't send you any info because you're putting it in after taxes. So then at the end of when you retire, at the end of your working years, when you start taking the money out again, that is when you are not taxed, when you take the money out at the end. And a couple of reasons I think that's better is because the difference between a 401k and an IRA is that if a company, let's say you're going to get paid $1,000, the company takes the $200 out before you are taxed, so you're only taxed on $800. If you do an IRA, then the company you're going to you're going to get paid $1,000, and then the company takes out your taxes, and then you have the money, and you put $200 into your account, and you then get that piece of paper at the end of the year. But in this case, you were taxed by your company at 1,000. So you were taxed on more money. So let's say you're in the 12% tax bracket, that's $120 that you were taxed, whereas your company taxed you $800 at 12%, which is less. I don't know off the top of my head, but it's less than being taxed at $1,000 at 12%. So I think a Roth IRA is better for that reason alone. But then also a lot of things point to, if you're going to have the money you're in at the end of your life, you want to make sure that you get the gains on the. I'm getting too detailed. I know. I'll stop. You're getting the gains on the retirement account for tax free as well. So there's lots of benefits. Start saving. No matter what you do, having the money at after you're done working is good for your future.
Thank you for that. But I think the Roth is also decent because I think it depends on your tax rate. Because you're going to be in a higher tax bracket by the time you retire, anyways, right?
Mm-hmm. Well, yeah. Let's say
that
right
doesn't
now.
Make sense. Never mind.
Well, okay. Let's say right now I am having an income from a company, and that income is higher than what I ended up planning to take out of my retirement account when I retire. So if I have more money as my income now, I could be at a higher tax bracket now than when I retire because I will be making less money then. So then I will be taxed at a lower percent later on, and that's when a Roth IRA would be taxed when you retire. So my philosophy is just never try and like shortchange yourself, and I think that an IRA is a little bit of that. But a 401k, honestly, if you have the opportunity to do that, definitely.
To be honest, as long as you're contributing to one and or both of these and saving for, in some way, shape, or form, it's extremely beneficial to do. Just because, like, again, it kind of goes back to the savings account that I was using earlier. It's just like it was great that I don't like saving money like that because I'm not doing anything with it, but it's super important to invest early so your interest on your retirement account can compound, kind of like the example we were talking about with the credit card where that compounds and gets scary. The retirement account's the same way. It can compound and get really good, and that's how a lot of people save for retirement because it just keeps snowballing your returns because the more you put in, the more you can get out later.
Absolutely.
So like I know I have a 401k through my company, and my company does a match, which is awesome.
Lucky.
Yeah, I know. Dude, you could have just stayed. Like, you decided to leave, okay?
I moved up to the northern burbs and, all of this other stuff with life.
So what? Chris still works downtown?
Yeah, I know, and he commutes like 2 hours a day.
He likes it, so he can play video games.
Oh, totally. But if you want to talk about more fun investments rather than a thing that you should be doing, there's stocks, and stocks come in multiple forms. You can get them.
Dude, slow down. You jumping the gun. Retirement accounts are so important. I know they're boring because it just gets taken out of your paycheck.
But they're made up of stocks. Huh?
They are. But like, oh my God, I don't even know how to explain to you. It's so unbelievably important to save for a retirement account. And you know what? I understand that like some people might need the money every paycheck to paycheck. But even if you put away just like a tiny bit and just make it work, like I know I try to set up my retirement accounts and all my accounts so that way I force myself to like spend less because otherwise it won't work, my plan. So I highly recommend at least sitting down and trying to figure out how much you can put away. Just because your employer doesn't match does not mean you should not be contributing to a 401k plan. Just because your employer doesn't even have a 401k retirement plan does not mean you should not be saving for retirement because it's one of those things you'll thank yourself later for and is crucially important. There was another point I was going to make on this. There's a bunch of different allocations you can do on your retirement account that have to do with stocks and stuff. If your company doesn't give any basic information, I'm sure that there's some stuff on Wikipedia that can kind of explain to you, what you should be looking at. I think the recommended on like Wikipedia is like the lazy fund portfolio where it's like you invest like 40% in international total market stocks, 40% of domestic stocks, and 20% of like bonds, like total market bonds. And
I'm actually surprised that one is called lazy because they have an even lazier version. A lot of places that offer a retirement account will offer you a life, like an age-based account where you can say, I think I'm going to retire in my case, 2055.
Yeah.
And so if I pick that, then they will do all the hard stuff of making the risk high right now, low when I'm about to retire. I don't even need to think about it again.
Yeah, and it's just one of those things that you just can set up and just have a basic understanding of like, all right, here's where all my money's going. And then you really don't have to log in and reallocate ever again. Like just like what Sydney said, like if you pick a target thing, which is a great
Target
one.
date.
Target
Thank
date.
you.
You pick the target date account, which I know that Vanguard does, and like a couple other
Almost all of them
yeah,
have
I
it.
think they started doing it because it's so easy. Just pick one,
Exactly.
invest into it, and then you don't have to do any allocation. You don't need to try and be a stock wizard. And then
Hmm.
the only thing you really need to look at is like how much of your paycheck you're allocating. If you're going to max out, is another important thing with retirement
Totally.
accounts. Is certain accounts like 401k I think is like 18,500 is the max you can contribute in a year. It might
And
be
that changes
18.
every year.
Yeah, so it goes up, down, sideways. Sometimes stays the same. And then I think the IRA is like 5,500.
55. Yep.
Yeah. And then there's some weird backdoor thing that I don't fully understand. I'm not going to try and explain that. Let you do more potentially, but
No, that's actually what I was describing, but even more complicated.
yeah, it's tough. But those are the two basics: retirement accounts. And the one thing I will say you need to monitor of it is if like you do get a raise or something,
Yeah.
and you're not maxing out your retirement account, I recommend trying to keep your lifestyle the same. Like first thing you want to do is when you get a raise, it's like, oh my god, I'm gonna go party, or I'm gonna go buy this thing I've been wanting, or my spoiled fiance deserves something, and
Oh, she's gonna love hearing that.
yeah, she's already spoiled, but it is important to try and raise your allocation to try and max out your 401k or your IRA if needed. I think, I'm not sure about the IRA, but I think the 401k, if you have a decent company monitoring it, will stop contributing if you hit your max.
Unfortunately, an IRA won't, which is another scary
Right.
thing about an IRA. And then what it'll do is it'll give you that sheet of paper at the end of the year, and it'll have too much money on it. And so then you'll get penalized for having put too much money in an IRA and gotten the tax benefit on too much money. So you'll actually pay the taxes on that money. That'll be added to the taxes you already owe. So you kind of just work it out so that doesn't happen when you create the account.
Correct. And, it's a very basic thing if you're contributing on something like Vanguard or Charles Schwab or any other type of account. I don't know. What do you do? Would you have a
I,
specific?
yeah, I actually, when I left my last company, I had a 401k, and that then traveled over to a specific company because that were the people that were managing it when it was a 401k, and it's called American Century Investments.
Okay.
And they also had Roth IRAs. So I actually left my 401k as a 401k. I didn't touch it. I have separately the Roth because then when I, in the future at some point in time, or if my company offers it, have the opportunity to do a 401k again, that money can then just like smoothly slip right back into being a 401k. Whereas if I turned it into the Roth that I'm doing now, it would be the complicated stuff I said earlier about it having to like no longer being a pre-tax thing and blah blah blah. So it's just chilling, and now I'm Roth IRAing instead.
That's funny. It's just chilling.
Well,
So
it's growing. It is actually
yeah,
growing.
it should be. The stock market's been killing it the past couple of years.
Hmm.
Since our president has been elected, at least.
Oh, since before then too. Just saying.
So either way, get to know your retirement account. It's super important. I mean, I think my IRA is with Charles Schwab right now, and it's super easy.
Nice.
Um, I set up an automatic payment just to deposit it
Hmm.
over, and I do the same thing with my savings account. So that way, I do it on payday. So that way, when I get my money, it just goes over there. I don't even see it. I don't get to use it. It's just gone until I'm like 65 or something, and you can actually take it out.
Nice.
So I
So
think that
now's the
was
time
it.
for stocks.
Yes, now you can get excited.
Yay!
The reason Sydney's
So
so excited is because she just opened up a stock investing account on this
yes,
platform called Robinhood, and I'm sure
it's
she's
so
been
much
doing
fun.
some crazy stuff. So
Oh
tell
my
us what
God.
you're doing. Have you lost
Yay!
the house yet?
So I'm gonna start teeny tad bit basics first. There's stocks that you can buy individually, and that's what I'm doing on Robinhood. And then there's stocks you can buy like grouped together, and those are called funds, like index funds or mutual funds or that kind of thing. So I do both, and I started off with funds because they are a little bit more safe. They're a little bit more accessible, and they're not as risky because an individual fund, an individual stock depends directly, like it is directly correlated with how well the company is doing. But that means that like if I think a company is going to do really well, then I'm going to buy their stock, and then they do really well, and I get to see like what's crazy is that the app I also use for my fund, I actually use Wealthfront, and the app for Wealthfront and the app for Robinhood are so very like if you're a gamer like me, they're so very gamified. They make me feel good because I can see all the stats of how well things are doing. And so you know how recently Tesla had that scare, and actually Tesla, Facebook, and Starbucks have all recently had scares and bad media. They've some of them have been doing things that have been questionable more so than others, and some of them are not showing as good not showing as good returns on what they're doing as the investors would hope. So their stock price went down. So I totally just went on Robinhood and bought one stock each. And ever since then, they've been up. Well, no, not true. Tesla went back down, but then it's up again. And so watching them is a little bit of a roller coaster. I will admit it is not good for my health. And I'm glad I haven't bought more individual stocks. It is absolutely safer and a better investment long term to do a fund because those can be geared towards things that you're interested in. Like if you want to do uh, Facebook, there are tech based funds that invest in multiple different tech companies. Like you might get a small little bit of an Amazon share, a small little bit of a Facebook share, and that will make up the fund that you've invested in. So while you're still basing your investment on things that you're interested in, Facebook cannot do well, but you only have a little bit of Facebook. And Amazon can do really well, and then that makes up for Facebook not doing so well. And that way, funds kind of are better for longer term because longer term, the stock market usually goes up. But then these individual stocks are actually super fun because I also bought some that have what are called dividends. And those guys are when the company makes enough money that they want to give back to their stockholders, then they actually give you a little bit of money. If you own one share of stock, they might give you $1, and that happens every so often. So right now I'm not getting very much, a little bit here and a little bit there, but it's still super fun.
Yeah, I mean, it also can lose you pretty much everything.
Yeah,
Because when you buy a stock, you're virtually owning a piece of the company, and like you'll get to vote. You can go to stockholders meetings where board of directors answers questions, and if you want to, or you can vote like online. I think some do, but like
not all are like that. And also, some you need to have a minimum threshold of something like 3%. And of a company that makes as much money as Amazon or
yeah,
Facebook, you might never, as an individual, reach 3% of their value in the stocks that you own of
right.
them.
And so it can be fun. I will say it's probably not fun for most people, including
Super
people
risky.
who are professionals at it. But and stocks you can buy and sell long term, which is over a year, at pretty much any price. But if you are going to what's called short term, or basically trading is what it's called, which is less than a year, you need a minimum of $25,000 in your trading account in order to get in and out in a year at a significant like it's like some federal requirements to protect consumers, basically saying you need at least $25,000 to go in and out of stocks consistently on a short-term basis. So you have to be
That's
very
interesting.
careful. You will like I know on Robinhood you will get flagged if you like buy Starbucks and it
Interesting.
goes up a couple bucks and like
And then
you
you
go
sell it.
out and then you're like, because me knowing you, you're gonna be like, oh my god, I made like $50 or whatever, so now I'm gonna buy McDonald's because they went
Okay.
down.
I will say, like the most that any of my stocks have gone up is Facebook at one point was up about $18 from when it was at its low when I bought it. But like since then, it's gone way back down, and Tesla's gone back down to almost breaking even to when I bought it. But they have gone up a lot and down. But I assume that the flagging happens at a bit more material of an amount.
Yeah, I mean, just be careful because I know they have a lot of fail stops, and they like I
Mm.
can't remember what happens. I think they suspend your account for like 6 months or something. If
Oh
like
man,
yeah, it's something weird.
good to know.
Um, I mean, you can try it. Just try day trading a
Actually,
couple days and see what
I'm
happens.
I'm just thinking that like this shouldn't be incentivizing me to try it, but I kind of want to find out what happens. And it's
You
also
could
like I
probably just read about it online, to be honest with you.
oh yeah, but firsthand experience is so much fun.
Yeah, right.
I only have one share of every. I bought a handful of stocks. I only have one share of each of them, so I didn't go crazy. I just basically wanted to have my hand in something. So I think like if I sold a share of Tesla when it went up and then bought it again when it went down and did that a couple times, I don't think they would even flag it. Fortunately, I guess that's a
But
good
I
thing.
think they do flag it at any like amount, to be honest with you.
Really?
Yeah, it's under
Okay.
25,000. Like you keep saying non-material, but like if you're trading a material amount, you're not going to get flagged 'cause it's not like against the law or something. I don't know. Anyways, you can read into it. Like it's
Yeah.
beyond the scope of what we're talking about, but basically, stocks. The reason people are attracted to stocks because you can buy a stock for like $1, and then it the next day, like if let's say you bought Starbucks for like $1, and then all of a sudden you guys a year later, it's like all of a sudden everyone's like, oh my god, like a better example would be Chipotle, I think. Because like when I was growing up, Chipotle
Yeah.
like was kind of a new thing, and their stock wasn't very high. I don't remember what the price was, but it was not
Hmm.
even close to where it is now. And then it's like looking back on it now, I'm like, everyone loves Chipotle. I love Chipotle. Why didn't I buy stocks back then? Because what happened was people saw value in the company, their revenue grew, they became profitable, they got more investments, and as the company got more valuable, because people were owning shares of it, the stock price went up, and that's kind of how the exchange works. Because you have to buy on a stock exchange, and all that is people buying and selling. And if there's more people trying to buy than there are people selling, then the price goes up because of basic economics saying, okay, since not everyone can buy what you have, your value goes up.
Totes.
And then the vice versa is true. Like if everyone's trying to sell, but there's not that many people wanting to buy your crappy stock, like right now, I think Snapchat's coming under a lot of fire because they've had
Oh.
some revenue and margin issues and returns.
Hmm.
And so their stock price has gone down because a lot of people are like, oh crap, they're not doing as good as we thought. We thought they're going to be the next Facebook, but now it's like dropped off a cliff. And Rihanna tweeted about it and said it sucks. And
That's
so
hilarious.
there's all these economic factors that come into play that affects stock. And it can be something
Hmm.
as simple as a celebrity saying, this company sucks. Or like when was it United that tried to like throw that guy off a plane and like beat him up or
Yep.
something?
Yeah.
Like their stock plummeted the next day. But
Totally.
it can be other crazy things like when SpaceX landed a rocket or something. Like their stock jumped up like crazy after that.
Totally.
So
Yep.
um, I would say the biggest things is like earnings reports, quarterly earnings reports. Company releases their actual earnings and their
Hmm.
profit, and then there's certain expectations that all these investors set, and if they beat that, it tends to go up. But sometimes it goes down. I don't know. I can't control them.
There's also this new phenomenon called robo advisors. And what that means is they will end up taking the money that you want to invest and you basically tell the platform your interest in investing, your risk level, your when you want to take the money back out. You give it all of this information, and they will invest in stocks that match or funds of stocks that match your interest level. So they'll end up finding the right combination of risk, short term, long term, foreign, international, or domestic, and they'll do all that work for you. And I have more money in these than I do individual stocks because I have a lot more trust in these than I do my own ability to pick stocks. But they also come with different fee structures than individual stocks do. So maybe a platform like Vanguard or or any platform where you're buying and selling individual stocks, they might charge you per trade. So in that way, you are getting a little bit of money taken out every time you buy or sell a stock. Robinhood doesn't do that up to a certain point, but once you have a certain amount of money with them, that's when they start charging you.
Yeah.
And then for on the other side of that, for funds, we've talked about one already, Wealthfront, but there's a couple others like Betterment or Acorns, two different platforms that do similar but different fee structures. And they're trying to get you to use their platform to buy funds of stocks so that you're getting investing experience. You're saving for whatever you're investing for in the future. But that way, like Wealthfront, if you have up to a certain amount of money with them, they won't charge you a fee. Whereas Betterment is up to a certain amount of time. If you up to a year, I think, they won't charge you a fee. Then after that, no matter how much you have in there. And then Acorns, they give you, they're actually a different platform. They're a fun one if you want to start at a very, very small level, because they end up charging you for it's $1 a month of a fee until you hit 5K, and then it's less than 1%. So they structure it that way because every time you make a purchase, they invest the change left from that purchase. So if you spend 20 cents on gum is not 20 cents anymore. If you spend $2.20 on a pack of gum, then they round up to the nearest dollar. So they'd round up to the third dollar, and that 80 cents they would then take to invest for you, just like Betterment or Wealthfront would invest for you if you just gave them that money.
Yeah.
So Acorns is a way to do it, just, back of your mind, not really thinking about it. It's happening no matter what. And Wealthfront and Betterment are a little bit more eyes on.
Yeah, it's an investment account, but you don't actually manage it like you do on
Totally.
like Robinhood. You kind of put money in, and they do it all for you. It's
Absolutely.
kind of like an automated financial advisor is what it is.
Yep.
There's people in the company that are obviously buying and trading stocks, but it's just different because it's probably based on algorithms or
Totally.
something versus having someone do research or in stock pick and stuff like that.
Absolutely. So something actually, I'm gonna go off the deep end if you let me for just like a short period of time. We don't have too much time left till we hit an hour, so I'm gonna go off the deep end.
Don't go too deep, Sydney.
So basically, cryptocurrencies.
Oh my God.
Just putting it out there. If you are going to have a cryptocurrency account, because we are talking about accounts in this episode, that actually needs a whole different. I would call it a platform, but it's basically like a bank for cryptocurrencies, because current banks do not hold them. You have to, something like Robinhood is a platform that will let you buy and sell cryptocurrencies. And there are a handful of them out there. But in a lot of these, once you step up a little bit from investing to investing into fun, weird, interesting stuff, those will all hold your money on these different platforms. So no longer are you having your money in a bank that can do multiple things with it, or on a credit card. You're actually giving this money to this this tech company that has come up with a really cool way to try and get you returns on your money. And cryptocurrencies in that way are just a different type of currency that you keep in a different type of account.
Don't buy cryptocurrency is the moral.
They're amazing. They're fantastic and awesome. And
how's your portfolio doing? Crushing?
Well, no, not
at all. Okay. Cryptocurrency is trying to substitute dollars and euros and all that other currencies backed by federal governments. And people make this stuff up all the time. I could rant about it forever. Stay away, especially like if you. It may sound
now's the
fun.
Time to buy.
It is not time to buy. There was never a time to buy. Right? If you read an article about some billionaire, he may as well just have won the lottery. That's like what cryptocurrency is right now. Okay, it's unregulated. It is so bad. Just like Sydney is not a financial advisor. Neither am I. But I will not lose you money compared to that. Anyways, what is the next topic? Jesus.
Oh, I don't know.
Wait, are we out of accounts? Did we go through everything?
Oh no, I still have 1, 2, 3, 4, 5, 6, 7 left.
Let's go.
Oh,
Crank them
okay.
out.
Well, I'm gonna make this super, super quick because we don't have much more time till an hour.
Why?
But
What
if you
happens in
want,
an hour?
well, at an hour, my memory card stops recording.
Lost! Well,
Uh,
should we do a part two? We can do a part two.
Ooh, that's not a bad idea. You want to do financial accounts part two next time?
We can. All right. So why don't you tell us what the accounts
Cool.
are, and then we'll sign off.
Awesome, cool. So these accounts are a little more obscure. So you might have accounts that help you manage your money because they are specifically tax benefit, like an HSA or an FSA. An HSA is a health savings account, an FSA is an, I don't know, financial savings account, something like that. And then there's also the opportunity to do maybe a commuter benefits account where you're able to do public transportation is paid for before taxes. Those are kind of tax beneficial accounts. And then there are accounts that you can have. This is a different category. Accounts you can have for other people. And something like that might be a trust, or if you want to start to save for college for someone else. And that might
529.
yeah, 529.
Yes.
And then that also kind of plays into student loans are another type of account that we didn't touch it over in debt, but has to do with saving for your future. And then another type of account that we haven't talked to is peer-to-peer lending. That's a little bit in the investment, but kind of really not because it's debt to one side and slightly investing to the other. And there are lots of things we can talk about that as well.
I would
So
say it's alternative form of traditional investing.
oh, nice. I like it. I
Yeah.
like it.
All right.
So next time,
That's what we'll
financial
do
account.
next time. I know
I
we're
like
getting really close to an hour, so
it.
that's what we'll do. I think we covered the basics. If you have any questions, you can comment on YouTube, which we will be
Yeah,
uploading to after, and we'll get some social media going on
totally.
Twitter and Instagram and
Hmm.
Facebook or some crap. I don't know. But that's probably it for now,
Yeah, thank you guys for watching, and we can't wait to give you more next time.
and that is PSBS.